When you hear about tariffs on the news, it's easy to think that's just politics. It doesn't affect me. But here's the reality. If you're a Canadian retiree or planning to retire in the next few years, these global economic shifts can have a direct, significant impact on your financial future. We're not talking about abstract stock market numbers or corporate earnings reports. We're talking about your groceries, your travel costs, investment portfolio, and ultimately, your ability to maintain your lifestyle in retirement without worry. New U.S. tariffs could trigger ripple effects that, one, increase the cost of living in Canada, 2, disrupt your investment returns, 3, devalue the purchasing power of your retirement income, 4, create long-term inflationary pressure that erodes your nest egg faster than you planned, and the worst part, if you wait until you feel the effects personally, it might already be too late to fully protect yourself. That's why today's video is so important. We're going beyond the headlines to uncover exactly how U.S. tariffs work their way into your retirement reality, the subtle risks most retirees overlook, and the smart defensive strategies you can put in place right now to stay one step ahead, because staying informed and, more importantly, staying proactive could be the difference between secure, confident retirement and one filled with financial stress you didn't see coming. Hi there, if you're new here, my name is David Drummond. I'm a certified financial planner and the founding partner at DLD Financial Group Ltd. For almost 3 decades, I've helped Canadians across the country protect their wealth, retire with confidence, and navigate complex changes like the ones we're seeing right now. Today, we're talking about something that might seem like it only affects global headlines, but it actually has serious implications for your retirement savings: U.S. tariffs. Tariffs are back in the news, and they're more than just political talking points. If you're retired or close to retiring, these changes could quietly eat into your investment returns, increasing your cost of living and create long-term risks for your financial security. So if you're a Canadian retiree wondering how these economic shifts might affect you, you're in the right place. And before we jump in, if you find this kind of breakdown helpful, don't forget to like, comment, and subscribe. It helps us get this content out to more Canadians who need it and keeps you in the loop as markets evolve. Well, let's get into it. Part 1. What are U.S. tariffs and why do they matter to Canadian retirees? To understand this matters so much, let's start at the top. What is a tariff? A tariff is a tax that one country places on goods imported from another country. When the U.S. imposes tariffs on goods coming from abroad, including from Canada, it makes those goods more expensive for American consumers. But here's the part most Canadians miss. Tariffs don't just hurt exporters. They can come back to affect consumers, investors, and retirees right here at home. Let's break it down. When Canadian companies sell goods to the U.S., which is our largest trading partner by far, they rely on competitive pricing. If U.S. tariffs suddenly make those goods more expensive, Canadian companies either lose sales to cheaper alternatives, hurting profits, or absorb the costs themselves, hurting margins and share prices. And either way, your investment portfolio may take a hit, especially if you hold dividend-paying stocks in sectors like manufacturing, energy, or natural resources. But that's just the beginning. Retirees live off fixed or semi-fixed income, and tariffs can indirectly increase the cost of everyday goods like imported produce, manufactured goods, vehicles and electronics, building materials, which can spike if you're planning renovations in retirement. Tariffs can also stoke inflation, and inflation, as we know, is the enemy of every retirement plan. When prices rise faster than your income, your purchasing power erodes. Your dollar just doesn't go as far, and over a 20 or 30-year retirement period, that adds up fast. Here's a simple example. Let's say you have a retirement income of $75,000 per year. Even modest inflation of 3% per year cuts that income's buying power by nearly half in 25 years. Now imagine if that inflation is worsened by ongoing trade disputes, economic retaliation, or rising commodity prices due to tariffs. That's the silent risk retirees face. Not just market volatility, but creeping erosion of your lifestyle. And that's why understanding how tariffs work and how they trickle down into the real economy is crucial for long-term planning. Part 2, the ripple effect on Canadian investors. So how exactly do tariffs imposed by the US affect your retirement portfolio as a Canadian? It's easy to think that this only applies to exporters or politicians, but the ripple effects can directly impact your nest egg, especially if you're invested in Canadian equities, have exposure to US markets, or rely on stable income from dividends and balanced portfolios. Let's break it down. Number 1, market volatility. Whenever tariffs tariffs hit the headlines, especially from major players like the US, markets tend to react. Investors worry about trade wars, reduced global growth, and higher costs for businesses. This can trigger stock market pullbacks, sector-specific volatility, especially in manufacturing, energy, agriculture, and automotive, currency fluctuations, which can hurt your international holdings. If you're drawing retirement income from a balanced portfolio, volatility can be more than just uncomfortable. It can be dangerous. Selling investments during a dip to fund your lifestyle can permanently reduce your capital, a risk known as sequence of returns risk. Number 2, increased costs of goods. Tariffs often lead to higher import costs. That means Canadian companies that rely on US goods or selling into the US markets might face slimmer profit margins. And the result, lower earnings, reduced dividend payouts, and underperformance in key sectors of your portfolio. But it's not just your investments. If tariffs increase the cost of essentials like food, appliances, vehicles, or electronics, your cost of living goes up too. This erodes your purchasing power, especially harmful in retirement when you're living off a fixed income. Number 3 is Canadian dollar impact. Trade tensions tend to devalue the Canadian dollar relative to the US dollar. If you travel to the US, spend winters down south, or buy goods priced in USD, this makes things more expensive. But the real kicker, it can also impact your US-dominated investments. If you own US stocks or ETFs in a non-hedged Canadian fund, fluctuations in currency can either boost or hurt your returns. It's just not always predictable. Number 4, interest rate implications. Economic strain from disputes can influence central banks. If inflation rises due to tariffs, rates could go up, affecting bond prices, mortgage rates, and borrowing costs for companies. If you're holding long-term bonds or investment-sensitive assets in retirement, this could eat into your fixed income yield or reduce bond values. So in short, US tariffs don't just hit the headlines, they hit portfolios, purchasing power, and planning assumptions. Next up, we'll talk about what you can actually do to protect your retirement plan in a climate of rising trade tensions. Part 3, what Canadian retirees can do to protect their plan. If you're retired or getting close, you might be thinking, all of this sounds worrying, but what can I actually do about it? A great question, because while we can't control the decisions coming out of Washington, Ottawa, or Beijing, we can take steps to protect our retirement income from volatility, inflation, and economic headwinds. Here are several key strategies I recommend to clients. Number 1, revisit your asset allocation. Tariffs create uncertainty, which affects different sectors in different ways. If your portfolio is heavily concentrated in Canadian exporters, resource companies, or cyclical sectors, you could be taking on more risk than you think. Now is a smart time to rebalance your asset mix between equities, fixed income, and alternatives. Diversify to reduce your home bias, but also hedge currency risk where needed, and stress test your portfolio against global trade shocks. If you're drawing income from investments, this is especially important. A well-diversified portfolio helps protect your withdrawal strategy in both good and bad markets. Number 2, add inflation-resilient assets. If tariffs push up prices through more expensive imports and supply chain disruption, inflation can erode the real value of your money. Consider allocating a portion of your portfolio to assets that historically perform well in inflationary environments, such as real return bonds, infrastructure and utilities, REITs, real estate investment trusts, commodities, or resource-related equities, carefully selected, of course. These types of investments can provide both income and purchasing power protection. Number 3, secure a tax-efficient withdrawal strategy. When markets get choppy or inflation rises, one of the biggest risks to your plan isn't just volatility, it's inefficiency. If you're pulling from the wrong accounts at the wrong time, you could be triggering unnecessary taxes, losing out on government benefits like old age security or OAS, draining your portfolio faster than needed. Ensure your withdrawal strategies align with your tax bracket, account types, RRSP, TFSA, non-registered, and the timing of your government benefits. A small tweak here could mean thousands of dollars saved in tax and more income staying in your hands. Number 4, build flexibility into your retirement plan. Retirement isn't static, and your plan shouldn't be either. Market volatility from trade tensions, interest rate changes, or inflation shocks can happen at any time. You want to make sure your spending plan can adapt in down markets. You have a cash reserve for 6 to 12 months of expenses. Your income sources such as pensions, investments, and annuities are coordinated to provide consistent cash flow. A good retirement plan isn't about predicting the future, it's about being prepared for it. US tariffs may seem like distant political issue, but they can have real measurable impacts on your retirement security. And in a world where headlines move markets, the best defense is a solid, flexible plan tailored to your goals. So if you're not sure how exposed your retirement income is to global trade risks or how to rebalance your plan for more stability and tax efficiency, I'm here to help. Click the link in the description to book a personalized retirement retirement review with me, we can walk through your portfolio, identify areas of risk, and build a strategy that protects your income, no matter what headlines come next. Thanks for watching. See you next time.